Going into like from this big event that took place, what do you think is required to make it more sustainable for like those type of participants in the markets, like the retail trader that wants to come in, gets kicked out again, altcoins are suffering again. What do we need in terms of safety to prevent this?
I think obviously the large issue almost, or consideration that comes up every single time one of these big liquidation moves happens, is the levels of increased leverage in the system building up to it. And in any market, anywhere in the world, like large increases in leverage are almost completely correlated with subsequent blow-ups in some way, shape or form. And yes, we're in a new market. We're in this growing world of digital assets where things are being reinvented somewhat, but the core first principles do remain. If people use a lot of leverage, at some point, like this is how things end in the short term. So I think that component is very difficult. What the solution is, I don't know, because if centralized exchanges cap leverage, it would push people onto DEXs and it would still continue.
Fair enough, yeah.
It's more of like moving from this model where people are just seeing this as speculative assets to let's trade this more like an equity where you have an underlying cash flow and you have a reason to believe in something, and therefore you can sit in something for a longer period of time because you believe it's going to go up and you're not trying to guess the next 100 basis point move in something intraday. That's where ultimately this churn happens. But then on the other side, like yourself, like if you're investing in things because you believe in things, and those long-term holders, that is the people who will sit in spot or use a little bit of leverage. Leverage is great in the right scenarios. It's bad when you get everyone piling into something. You see it in the funding rates, right? Like every time Bitcoin's made a new high, you look at hyperliquid, which I think now is probably a bit of a better proxy for the actual leverage in the system, because there's a lot of other projects that are obviously running these huge basis trades on, I guess, your traditional sexes, and even the CME, which is compressing that. It's no longer a great signal. But then if you look at that on decentralized exchanges, it's not the same. So you can see where the leverage is getting quite large. And that sort of makes you think, okay, that's actually the pocket where it's happening at the moment, which is why I go back to that microstructure point, in that it is being really interesting to see like how traders have moved and leaned towards these DEXs. Obviously, a lot of them, and there is some capital there that won't be sticky. They might be just looking to farm an airdrop. But ultimately, I think when people interact with those and like learn about them, then ultimately that is probably flows down from there. And if people stay on those venues, that's going to be something to watch. But
good one. I think if we look at safety measures in general, I think one of the most common topics right now is circuit breakers, which is very difficult if you have so many houses to trade on.
Yeah.
The other one is, your background is also outside of crypto.
Yeah.
I think you've been trading oil.
So I was in a global macro seat before. So I traded everything from like oil to like lean hogs to like obviously then single name equities to FX. So yeah, everything under the sun ultimately.
But that's a different market.
Yeah, very different market.
And if you want to trade, probably a lot of those commodities with equities, with leverage, it's not as easy as with crypto.
Yeah.
So from safety measures, you would argue that lowering the leverage on all the exchanges is probably the safest way going forward.
Yeah.
Because retail traders have the impression to go more risk on by adding leverage, while leverage is actually mostly being used to decrease risk.
Yes, for sure. Yeah.
That's how you should be doing it, right?
Yeah. I mean, well, that's like if you think about the use in crypto of even something like options, right? Like options at their very core in any other market are insurance products. That's what they are.
Yeah.
Not in crypto. They have been traditionally used to add leverage. And that has been, to be fair, that is changing, and we're seeing a lot of that flow changing. You can see it in like the nature of like the volatility surface. But historically, that wasn't the case. And that's just because everyone is just looking to add leverage when they think the market is hot.
Yeah.
And that comes again like to perps. Like traditionally, people would use futures to hedge risk.
That's how it used to be. Yeah.
Oh, that's how it used to be. But now, obviously, these amazing products called perpetuals, which at the very nature are fantastic, great product market fit. The NASDAQ is now looking at them like they're probably going to become the gold standard in leveraged futures markets all around the world at some point. I do believe that because they have huge advantages. The disadvantage, obviously, as you said, for longevity and the short term is that at the moment there is no cap on leverage. But being realistic, as you said as well, like because there's so many different exchanges, if one exchange capped people at 10, another one would use that as an advertising model to bring them over. So in a realistic world, I don't know if that is the answer. Circuit breakers, yes. I do think that would be in an ideal world. But again, the level of fragmentation and who's going to police that? Because there has to be someone to police that if that's market wide. Like that doesn't, at the moment, doesn't work. That is a problem that I'm sure at some point someone will try and solve. But when you have so many different DEXs on so many different chains, and then you have so many centralized exchanges, you're going to, at some point, to even consider putting that model in place, you would need someone overseeing that whole market structure. And then I guess you get into arguments, who's the best place to do that, which I guess at the moment, I wouldn't even know where to start with that argument.
No, that's like, it's so difficult. I mean, even from that example, but there's a different example. I'm from Netherlands.
Yeah.
We have Michaël, which basically excluded me from trading on Binance for already like 4 or 5 years. And then one exchange after another left the country. And then you're basically left over with Maxi and a few of those like tier whatever exchanges.
Yeah.
And you're not able to trade futures. So what do? You go onto Hyperliquid or onto Aster or any of the other ones and trade futures there. And then you can create a regulation, but it doesn't have any impact at all if you have a DEX.
It doesn't move the needle.
So then it brings me back to how are you going to create an efficient market?
Yeah.
If people want to trade with that leverage, well, let them, but that ultimately also ends up with people being kicked out. And then we are going to keep having these sort of events.
Yeah.
It's just a big sort of trade-off, like one way or the other, it's not going to be fully practiced in an efficient way, right?
I guess like the flip side to that is that considering where the market is now compared to 5 years ago, right?
Yeah.
We are trending in the right direction. These things never go in a straight line. Like we were going somewhere, FTX happened, that big blow up, you saw all of the contagion, that set us back a couple of years. Then we've gone up again, and now arguably we've had this big liquidation event. We don't really know what comes out the other side of it. You know, there's a lot of pain somewhere. You can sort of pinpoint where the rough problems have stemmed from, i.e. leverage, but it's very difficult to find an exact actor in that space. But like any market development, like think 2008, no one really knew about CDOs beforehand, right? No one knew about like this rehypothecation of mortgage-backed securities. After that blew up, the regulation happened, people realized, okay, let's do that so it's not going to happen again. And markets, again, like they are going very back to first principles again, like people do learn from their mistakes. And this is something that people now will look at and say, okay, well, that's, as you said, like people learned about ADLs. Now, everyone, I think, really trading this actively is very aware of what that is and what the impact could be. Before last week, very few people in the market probably were. And that has changed itself. So then you say, okay, well, the next big dump is probably not going to be caused by that because something else, and it'll be something else. Like markets don't tend to crash or have a big negative event when something is expected or very well known about, because people can arguably always model something in their head of the risks there. Mm-hmm. And it's always the thing, it's the devil you don't know that ultimately ends up being the big impact. So
funny enough, I started reading the book, The Black Swan, during my holidays.
Taleb.
Yeah. It's not about like those big events, but it's in the context of everything.
Yeah.
Like how much do we know that we don't know?
Yeah, exactly.
That's essentially like basically everything is a black swan.
Yeah.
That's what his conclusion is. It's fascinating to read.
It is, yeah.
And then it's also like, how are you going to optimize for the outlier, or are you going to optimize for just everything? And then there's that one tiny bit that if that happens, it happens and it's out of your control.
Yeah.
And that feels like we can spend a lot of time making this better, but this was just a chain reaction of events taking place in such a short window of time that we couldn't prevent.
Yeah.
I kind of feel like that was it, to be honest. Trump saying something, fine.
Yeah.
Then the Binance 3 pairs that basically broke down because they were going to be priced different in a few days. Coincidence.
Yeah.
And then, market makers being full with their inventory on Binance, not being able to deposit.
Yeah.
That caused the entire reaction on the market, right? So how was it for you to run the OTC during those hours?
Yeah,
I mean, it should be very difficult.
It should be very difficult. Yeah. I mean, again, like a lot of it comes down to like if the pricing holds up and you can trust your price as your mid price, it's fine. As soon as you lose faith in the ability to trust a mid price, then you can't show a bid and offer that you'd stand behind. And when things were off on different exchanges and people were trying to come together and think, okay, what's right, what's wrong, what are you taking out of the pricing, etc. All of that is a process. A lot of that happens very quickly as well, right? A lot of it was looking at, okay, even down to like pricing at that point, someone looking to do like a big USDT trade. USDT on different exchanges was trading all over the place. So even that as a very simple, like vanilla example, it then becomes, okay, you can't just trust your mid price. You've got to look at what you've actually got to be super aware of what is going on around, like why is that over there, and really why it was over because everyone was buying it and because they were getting liquidated and or selling down anything that they did have, and they were bidding up USDT, for example. But that was happening on one exchange and it wasn't another. So then that feeds into your estimation of where price should be, and then that allows you to keep the show on the road ultimately. But yeah, it very much was like we were very cognizant of all of our competitors. Again, going back to like the game theory, right? Like everyone is in the same position, and it then becomes almost like let's keep running, let's keep showing pricing, let's make sure everything is back in line as soon as possible. We want to be the first people, and we want to have the highest uptime. And genuinely, I think we did a very good job at it. And so yeah, then after the first half an hour, it's sort of okay. You've obviously got to quote wider because by proxy of the ranges, and because we're a prop desk as well, any trade that we take with a counterparty becomes our risk at that point, and we have to be happy that we can hedge out and obviously still take a spread. So there's a lot of different things that we had to think about, but yeah, ultimately another day at the office, I think.